You watch metals and markets every week, yet still shop with the big guys? Why pay more for your precious metals from the guys who have offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like Silver Shield and Heroes, SD War Collection, to our exclusive new line of insurance, approved, TL-rated precious metal safes, SD Bullion is what you're looking for. At the lowest prices, period. Guaranteed! Because if you don't hold it, you don't own it. SD Bullion, founded by stackers to help you prepare for what's coming. Shop with the doc today at sdbullion.com.
This is the doc and special guest host Turd Ferguson filling in for Eric Dubin on the SD Weekly Metals and Markets Wrap. Turd, great to have you back joining us.
Hey, what's up, Doc? I'll try to fill Eric's shoes, but they're pretty big shoes to fill.
Well, I'm certain you'll do an excellent job today, Turd. Well, we'd actually already wanted to have Turd join us today. What better time to have him back on the show than another epic cartel raid on the jobs report, the BS report this morning. Just pretty astonishing what the BLS reported. 423,000 jobs gained in November is what they revised the data to. Obviously the big January number as well. And just the thing that I was just chatting with Turd with before we started recording, it's quite astonishing with the Tyler's Zero Hedge cut that the BLS reported only a 1.9 thousand drop of jobs in the energy sector, and yet the actual publicly reported numbers from companies themselves are over 18,000. So caught with their pants down, whatever you want to call it. Everybody listening to this show has known for years, or should have known for years, that the numbers are all fudged. But
yeah, that right there is proof, evidence, whatever, that the numbers that the BLS puts out are all just statistical samples. I mean, they've got their models. That's what all these seasonal adjustments are. It's just a basis of, what maybe has happened in past years. And so they figure, well, that probably happened this year too. And so rather than the actual facts of these companies reporting 18,000 job losses, they go instead with their statistical numbers instead, the made up stuff. It's nonsense. And again, all of these seasonal adjustments, the pundits on TV were claiming how, oh, well, this is going to always so volatile, and January will always be revised one way or the other, so don't get too worried about it one way or the other. But then it comes in a little bit above expectations, and all of a sudden it's all sunshine and lollipops. Oh, this is the best report we've seen in a long time. So again, though, it's just used as cover to not only mess with the metals, but just markets in general, and it's hard to even take it seriously anymore, and I'm not sure very many people do.
Well, let's transition here and get to the metals here, Turd. Interestingly, the raid began about 15 minutes prior to the release. Really, it began right around 8 o'clock or 30 minutes prior to the release. It didn't start on the release of the jobs report. It started prior to it. But again, just a big raid. Silver just smashed right through 17 down to just about 1650. Gold took out 1250 really without much of a pause at all. It did find support around 1230. We were chatting before the show that I believe really the more crucial support is 1220. Well, we're not too far from there. I would be surprised if support doesn't hold at 1220. What's your thoughts both in today's takedown as well as the market as a whole?
Do you mind if I ramble for just a second, Doc?
Not at all.
There's a very big picture here I've been writing about for the last couple of weeks in anticipation of this very decline that's now been going on for 2 weeks. And there's a big picture that I just don't think very few people seem to understand. I mean, a lot of people aren't very sophisticated in knowing how the stock market works or anything in the first place. But at least the stock market has this notion of, I guess, a somewhat fair price in that on any given day, let's just pick a company, Intel has a certain amount of shares outstanding in their float. Now, of course, a company can always increase that by doing a secondary offering and stuff. But on any given day, there's a certain amount of shares either up for sale to be traded from people that hold it or want to buy it or want to sell it or whatever. And when there's a news event or when fundamentals change and there's demand for that stock, price rises as You have to find this equilibrium where existing holders are willing to sell to the people that want to buy it. And that's how you get stocks that go up 10%, 20%, 50% in a day. But that's not how it works in the metals. And I think people think that that is how it works, but it's not. In this paper derivative market, the COMEX, whenever there is demand for paper metal, as we saw all through January, instead of reaching a fair equilibrium based on a current existing amount of contracts, the bullion banks like JP Morgan, Morgan Stanley, Scotiabank, they just issue more contracts.
And what that does is it stalls the momentum.
Exactly. It dilutes what's out there. And rather than having big moves that initiate momentum and get people excited and, oh boy, it blunts the momentum. We get this flood of brand new contracts to meet the demand from people looking to get into paper metal. And so what happened all through January, you got speculators coming in, the euro's going to hell. We got the Swiss National Bank stuff, all this stuff going on. And everybody's trying to buy paper gold for whatever reason, and price goes up $100. And into that, the banks issued 100,000, 10 million ounces worth of paper gold, 100,000 contracts. It got to this extreme, price got up to $1,300, at which point, because they've issued so much paper, the momentum dries up. The market begins to tip over. The banks kind of give it a shove as well. And then finally, the speculators begin to liquidate because, oh boy, well, let's ring the register on this. We've already made 7% in a month, whatever, and down price starts to go. Heading into this week, it was really easy to see what they were doing. All through the week, we bounced off of the 200-day moving average, key technical indicator in the April gold. We bounced off of it 3 or 4 times at 1256. A couple times even just yesterday. They never took it through there because they wanted to wait to get it with the biggest bang for their buck, which was today at the release of the jobs report. Immediately blew through the 200-day. These speculators, these computers that are programmed to follow that stuff, all just head to the exits all at once, and all of a sudden we're 1235. All of that spec liquidation of the very same contracts they put on in January allows these banks to absorb that paper back in, cover up those shorts. It's a wash, rinse, and repeat cycle. At a profit, we might add. At a profit, exactly, and mission accomplished. Gold never took off. Gold never made it, blue never made it way up, and, this self-sustaining rally through 1,300 and beyond, that would get everybody's attention. No. Mission accomplished. Gold's right back down, up $50 for the year now. No big deal. The stock market's up, for the year as well. And that's how it works. Okay, it's not a fair market by any stretch of the imagination. And so when you had all of this paper get issued in January, you knew going into February that they were going to rig it back down so that they could cover their shorts back up. And that's exactly what they did. Today was part of that. There's probably still some to go. The same situation exists in silver, where, to no one's surprise, the CME raised margins again last night for the second time in 2 weeks. Raised margins. Why? Well, again, if you can now get this sell-off like we had today,
maybe they knew it was coming today.
Yeah, and with the margin hikes on top of the selling, your silver position in futures that you bought yesterday or last week was already underwater, and now you're being asked for more margin. You know what? Just sell the damn thing. Just get me out. It's just to get more of these speculators to move out, so that the banks, which again have been creating silver contracts as well, hell, the gross short position of the silver banks, again, Scotia, JP Morgan, and the like, is up to 608 million ounces of silver, paper silver. That's 3/4 of global mine supply. Short, naked, on the COMEX. Well, again, they can't take that risk, and so they got to rig price lower, try to get the specs back out through margin hikes and rating price, and here we are. And anyway, I wanted to put all that out there because there's a lot of lack of understanding, but then obviously deliberate misinformation out there to keep people saying don't understand what's going on. But what I just explained is exactly what is going on, and people need to realize and recognize that so that they can understand and then act accordingly in terms of making their investments.
And it really is exactly what we've seen in the paper markets over the last 4 to 6 weeks. However, that being said, Turd, what's your take going forward? Will the physical market allow them to be successful further, or will gold, the physical market, find support around 1220 at the critical level? Really, it seems like the cost of production, bottom-wise, from trading over the last 12 to 18 months is around 1,200. They haven't been able to keep gold under 1,200 for any significant period of time.
Yeah. I don't think there's any doubt, Doc. I actually wrote a note for my subscribers earlier this week, kind of summarizing my position that both gold and silver finally reached a physical floor bottom back during the month of November and December for a number of reasons. And I laid it all out in some charts for everybody earlier this week. And nothing that's happened this week or last week or today has changed my mind. When the price came down in early November and gold got all the way down to 1130 or 40 and silver broke not only to 15, but I remember that night, Sunday, the 30th of November, it broke all the way to 14 and change.
I certainly do remember that night. Yeah. I remember it well. We were up late working SD Bullion, taking orders, and the authorized purchasers from the Mint, they called their whole entire trade desk in on a Sunday night. And let me tell you, when you have a large bullion bank and their head of their trade desk is working at midnight on a Sunday, he's not happy.
There you go. I mean, it was the final high volume capitulation all through November, and it really culminated that night. The next day, taking that action into account, everybody that looks at a daily chart can still see the biggest engulfing massive daily bullish candle that you're probably ever going to see on both the gold and the silver chart. That's just one of the reasons that I'm convinced that we did see this kind of physically driven paper low. It was a point, remember the GOFO rates, which not coincidentally are no longer published. The GOFO rates broke and went historically negative beginning November 5th. Okay, that was when the price initially got down to 1130. We reached a point where that physical paper connection, if it didn't break, frayed to where it was just held together by a couple of strands. Price then, they tried to get it back down at the end of November, as I just said. It rallied again in early December. And then, this is important too, was both gold and silver were pressed lower again in like a double bottom attempt, even maybe triple bottom type thing in the last 2 weeks of December. And it did so on much lower volume, maybe half the volume that we saw in that initial capitulative selling in November. So you come down with this huge volume, capitulation selling in November, a little bit of a rally, and then you come back to the same levels on not even half the volume. I mean, that's about as solid of a low as you're going to find. And you factor in all that physical stuff we talked about. I'm convinced that those are the lows. And yeah, it's not going to be easy. I mean, we started the year in silver under 16. So even a 30% return is only going to take us, barely back north of 20, right? So it's not going to be easy. And we're not, going back to, happy land overnight. But this idea that people are waiting to buy physical, or they think that they're not gonna, that they don't need to own it because they read some goon with a book to sell says gold's going to 250, that ain't happening. It's not going to 250. It's not going to 950. Silver's not going to 8. It's not. We've seen the lows, and people, again, if you recognize what's now going on, the way the COMEX leads these speculators around in this wash, rinse, repeat cycle that just culminated again today and maybe a little bit more next week, then you can use this all to your advantage, recognize what it is, and go, well, hell, I mean, if prices aren't going lower, I might as well call up the dock and buy myself another tube of Eagles. And that's what people should be doing this weekend, no doubt about it.
And one other thing that I want to point out, just to really substantiate everything that you just discussed, Turd, was the mining sector, the unprecedented volume of shares traded really from mid-December through mid-January. Go look at a volume chart of the GDXJ or some of the other ETFs or even the individual stocks. The volume traded is just massive, exponential from the levels traded over most of 2014. And really what that is indicative of is the weak hands finally tossing in the towel, liquidating their positions, and smart money just scooping up every single share they can.
Yeah, and they've had a very smart rally so far this year. This is another thing we've been talking about at TFMetals Report all week long. There's been a determined effort to keep an index like the HUI below its 200-day moving average for the last couple weeks, because that's, if that's just another key indicator that the miners have fully turned and recovered to crawl back above its 200-day and keep moving higher. But even after today's sell-off of 5%, that index is still comfortably up 20%, at least 25% from its lows. It's no longer overbought. It's about neutral. It's kind of going through a process of working off what I call that overboughtedness. And I think clearly the miners have bottomed as well and are poised to move higher. You got to be selective because so many of them have their own individual challenges, especially, after what we've been through. But for those willing to roll the dice and gamble on paper investments like that, there's probably some bargains to be had, no doubt about it.
Certainly there is, and the sales numbers for the U.S. Mint continue to be just exceptionally strong. January came in at 5.53 million ounces of Silver Eagles. Already the first week of February, over 750,000 coins. So we're up over 2014 numbers, and the U.S. Mint is allocating coins. The Canadian Mint continues allocating coins. So really, if you look at this market from a demand perspective, we really haven't seen any correction whatsoever. Demand has been really at the Mint's max for the last 3 years and holding steady.
And I know it's anecdotal because the U.S. isn't the biggest silver supplier in the world. But nonetheless, I mean, isn't it at least somewhat noteworthy that now for 3 or 4 years in a row, the U.S. Mint itself in just retail coin demand has soaked up, 125% of U.S. mine supply?
Right. And it's not just the U.S. Mint. The Chinese Mint, Panda sales have exploded. I don't have the numbers in front of me, but it's all up multiples just in the last couple of years.
Yeah. It's again, it means something. It's just one anecdotal data point, but it certainly means something. And again, I just can't stress enough. I mean, this idea, because there are people out there, wake me up when silver gets to 8 and that kind of thing. Like, okay, whatever, pal. It's not going there.
I couldn't agree with you more. And just as another interesting anecdote, I went back this week and listened to an interview from Hind Capital's Ben Davies that was recorded, I believe it was early November. It was prior to the lows. And as regular listeners know, I'm a big fan of Ben Davies. I think he's one of the premier analysts in our entire sector. He called the 2011 top in silver 3 days before the top. Back in November, well before the metals had bottomed in December, he predicted pretty much everything that we're seeing so far. And he put a number that he thought gold would make it to 1,300 by March, and that from there they would trade well for the rest of 2015. And really, he's been spot on. So I wanted to ask you a little bit your outlook here for the rest of 2015, Turd. Would you agree with that as we trade here? We closed the first week of February, with silver back under 17 and gold around 1230. Do you think silver will get it back above 20 here in 2015, as well as for gold? Kind of what's your big picture without any specific dates or numbers? What's your big picture view for the rest of the year?
I do with a couple of caveats, I guess, Doc. Like we talked about, from the December 31 low of 1560, a $5 move back up to 21 and change, is going to be 30%. That's pretty dramatic on a year-over-year percentage basis. So people got to keep that in mind. Though that doesn't, hell, we went from 18 to 50 in 9 months back in 2010. So, I mean, doesn't necessarily mean that it can't happen. And the other caveat is, I'm the guy that we did this a year ago. And I said, I think we get to 26 by the end of the year. And we got to 22 and that was all she wrote. And my thought then was the old floor that held after the market broke in 2011 and 2012. The floor in gold that held for 19 months was 1525. The floor in silver was 26. And when we were talking last year, we were at 20 or so, and I thought, I think this is the year we begin to recover, and it looks like a year early. And I thought the logical place that silver would end up by the end of the year was somewhere pushing back up against that floor. Now the old floor is maybe closer to 22. So let's start there. Let's just see if we can't make a move from roughly 16 to 22 over the course of this year. Again, that's a at least 30% move, and I think most people, should be happy with that. Now, and if you're like me and you own it at 44, you're like 22. But nonetheless, I do think the recovery begins. I do think we hit that final breaking point physical floor late last year. And now we'll just see. And again, we're talking about the metals here that are over-hypothecated, over-leveraged. There are certainly 20, 30, 40, 60 beneficial owners for the same single ounce. People that think they own it, but they don't. We have no idea how much actual gold is left in the Western vaults. The demand from the East remains insatiable. Anything could happen at any time. So let's finally qualify it with that. If things don't change, if we're still dealing with the COMEX and all this other nonsense a year from now, then yeah, I'd like to see us up around 1,422, something like that. That'd be great. But again, you never know what's going to happen if you wake up some morning and China's announced that they actually have 15,000 tons of gold and they want to gold back the yuan, God knows how that might change things. And so
it certainly would. I don't know that they'll do it in 2015, but
right.
That day is coming, and whenever it happens,
that's exactly right. Exactly. Or, Russia announces that, they're liquidating the rest of their treasuries, as the war starts. I mean, anything could happen. And so when we're talking around numbers, that just presumes that the current system is going to make it another year. It might not. In the end, the thing I keep repeating, Doc, and I just repeated this again in the podcast I recorded for my subscribers about a half an hour ago. The price, the paper fiat conversion price of your metal. If you were to take your gold and go sell it, somebody would give you $1,200 for it, right? That conversion price is lower than it's been in quite some time, and it's painful to look at. Whatever. All I know is that metal, that physical metal, has never been more valuable than it is right now. Never. And that value increases every day, and that's why people got to keep stacking it.
Well, I think that'll be a good place to close and wrap up the show for here. And I guess to pat you on the back as well here, Turd. Either brilliant minds think alike, or else you're doing your homework, because those were kind of the same numbers that Ben Davies was looking for, particularly in gold, around 15 to 1550 is where he thinks gold will really take a pause, as a lot of that volume is worked off from those who really are scared out from the big move break below that 1550 to 1650 level.
Yeah.
What was that, about 18 months ago now that it broke down below that?
April of 2013.
Right. So it will likely take, outside of an event like the Chinese making an announcement that they have 20,000 tons of gold, outside of something like that, it likely will take a bit of time really to work through those levels. But that's
Doc,
what markets do.
Before you wrap up, Doc, let me give everybody else one more thing to think about then in that regard. As I said, there was that floor at 15 and a quarter and 26 that held for 19 months. And when that was deliberately broken in that huge smash on the 12th and the 15th of April in 2013, we bottomed out in the wee hours of that Tuesday morning, April the 16th, at 1320 in gold and 22 in silver. I thought it was going to be a V bottom. That's when I even said, if it goes below 22, I'll eat my hat. And I had to eat my hat with some Frank's Red Hot sauce. It was delicious. The point is, everybody accepts that gold and silver kind of move in tandem, right? I mean, I don't know what the correlation is, 0.9 or something like that. I mean, they move in tandem. All right, gold is obviously, just a couple of weeks ago, was pushing back almost to 1320. And if you and I are right, you'll probably be there again, as soon as March. Well, that equates to, if you will, from that breakdown, that equates to $22 silver. So if you see gold turning on a Euro crisis, Ukraine crisis heats up, all this kind of stuff, and you see gold pushing 1320 again, but you also see silver still languishing around 1850, something like that. I mean, I think it'd be logical for someone to presume that silver is going to rush to catch up and make a move pretty quick through 20 and 21 through 22. So
certainly an excellent
on
point.
A short-term the
ratio is so that's extremely low right now.
Exactly. And so I think people need to be aware of that. We talk about gold, and gold obviously drives things. If you watch gold and as things turn and we rally into March, and gold keeps going. Look back in time and see where silver was at the exact same time in 2012 or whatever. And then you kind of scratch your head and say, well, how come silver hasn't caught up yet? And you might be able to use some leverage there and make yourself some fiat if you pay attention to that.
Really, I couldn't agree more. Definitely an opportunity here. As I agree that silver is not only undervalued relative to the dollar and the other fiat currencies, but currently undervalued to gold in considerably when you consider the mining ratio coming out of the ground. I believe in I want to say 2012 it was around 11 to 1, then it narrowed to around 10 to 1. In 2014, I think the number was right around 8.3 to 1, and yet do the math yourself and look at what the gold to silver ratio is. It's not anywhere near 8.3 to 1.
And again, it is possible. I mean, we've all gotten the snot beat out of us for 4 years, and so you feel like it's impossible to string 2 up days in a row together. But even with the commitment of trader structure the way it is, even with the silver banks being naked short 3/4 of global mine supply, that's how much they were short in October of 2010. And if you go back to October 2010, price was at 23 on its way to 49 7 months later. So even with all this stuff as a headwind, and you think, oh my, it is possible. I mean, that things could, even with the COT structure the way it is. So I just urge people to watch gold real close. And if you see silver lagging, there's got to be a pretty good opportunity there to even participate in the casino and make yourself some fiat if you're so inclined. It's going to be a really interesting year, Doc, and it's just getting started.
Turd, once again, it was great to have you back. Before we wrap up the show, if you could let the listeners know where to check out all of your excellent work.
Well, I appreciate that. TFMetalsReport.com is the free site. It's a community like no other of people just like you and I. I mean, we all see it for what it is, and we're all helping each other out. For a whopping $10 a month, you can become a premium member. We call it Turd's Vault. And in there, we've had a pretty good year. I'll just leave it at that. Recognizing, as we talked about over the last couple of weeks, what's been going on and using that to our advantage. I encourage, I mean, it's $10 a month, but I think it's money pretty well spent.
All right. Turd from TF Metals Report is the guest host this week, filling in for Eric Dubin. So for Turd Ferguson and the Doc, thanks for tuning in to this week's SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.